I will straight away get into the topic, and maybe once I finish, if there are any questions, either in the chat box or if someone wants to unmute and ask, I'll be happy to answer that. So today's session, while we've themed it as are the markets due for a correction, I have structured this call in a bit of a educative format, where we will understand a few economic concepts, and those of you who are already well-versed might find it a little boring. So do be patient with me. But I believe that having an understanding of these concepts will help us to understand our current market situation better and take a view on what is going to be the way forward. So let me start with a simple concept of interest rates. Now, we all hear about interest rates going up, down, and why they are so important, etc. But let's take a step backward and understand what exactly constitutes interest rates. So interest rates are essentially a factor of three things, which we will understand as real interest rates, inflation, and risk premium. Now, real interest rates is what I need as a compensation for not using my money for my purpose. So I have some money. I can do whatever I like to do with it. I can probably buy a television set and watch TV, movies, etc. I can go on a holiday. I can, do whatever. I can do a fixed deposit. But if I'm not doing any of those things, and if I'm lending that money to you, what makes me comfortable to forego what I wanted to do? That is what is termed in economics as real interest rate. The real compensation that I need for not using my money for my own use. And real interest rate is a factor of supply and demand for money. So if I'm having a lot of money, and if you ask me for a loan, I may not mind giving it to you because I still have a lot of money. And therefore, I will charge maybe a very low rate of interest. But if I myself having very limited amount of money, and then you want to take a loan, and I'm interested in giving that loan, then probably I will charge a little higher because I don't have enough money. So real interest rate is the driver of the interest rates that we talk about, hear about, etc. The second factor determining interest rates is inflation. Now we all know inflation is rise in prices. So if I am giving 100 rupees to you for a month, and today if I can buy 10 chocolates with 100 rupees, and after 1 month, when you give back that 100 rupees to me, I can buy only 9 chocolates, then I want more money from you so that I can buy the 10th chocolate. So I'll tell you, instead of giving me 100 rupees, please give me 109 rupees because I want to buy at least the 10 chocolates that I could have bought a month earlier. So if inflation increases, interest rates go up. If inflation comes down, interest rates come down. The third factor that determines interest rates is risk premium. We all know that interest rate on a home loan is much cheaper than interest rate on, let's say, personal loan. Same person, okay, whether it is you, me, or whatever. If I'm taking a home loan, I get interest at a particular rate. But if I'm taking a personal loan, the rate is much higher. The reason is very simple. The risk associated with a personal loan is much higher, and therefore the interest rate will be higher. So topic number 1 for today, interest rates are a function of real interest rates, which is nothing but the compensation I need for not using my money for my use, inflation, which is rise in prices, and 3, risk premium, that is the risk associated with giving a loan. So this is topic number 1, concept number 1. Concept number 2 for today is about exchange rate. Now, every country has its own currency. We have Indian rupee, the US has US dollar, there is Philippine peso, Japanese yen. Every country has its own currency. And every country is literally free to print or create any amount of its own currency. When a lot of money is created out of nowhere and is chasing only a few goods that have been produced, then prices of that particular item in that particular currency goes up. So you have different items having different prices in different countries. For 1 minute, we will forget about transaction cost, transportation, and all those things. Let us assume that those are not there. But if $1 can buy 5 apples, and in India, if we have to pay 100 rupees to buy 5 apples, then we cannot exchange 1 rupee for $1. The person holding the dollar will expect 100 rupees from us because we can buy 5 apples either by paying $1 or 100 rupees. And therefore, the exchange rate of USD INR will become 100 rupees for $1. Now, India can reduce the price of these apples by producing more apples. As I said, if the goods are less, then the price will be higher. But if there are a lot more apples, then price will come down. So if India wants to produce more apples, it will need more money. And therefore, let us say it plans to attract US money into India. So we don't have money to produce apples. So we want the US guys to put in money into India so that we can produce more apples. So price of apples will come down. Now, a US investor, let us say, gets 5% interest on his deposit with Citibank or whatever US bank. If a bank in India also offers him or her the same 5%, the investor will not be interested. He will say, anyway, I'm getting 5% from my bank in US. Why should I part with my money and send it to India, etc. Therefore, to attract this money into India, India needs to increase its interest rates. So let us say India offers 10% interest. So now for the US investor, he can invest his dollars in US and earn 5% per annum, or he can invest his dollars in India and earn 10%. Now this is interesting. The US guy is interested and he says, okay, let me push money into India. Now you can't just walk into India and pay US dollars. We have a check post where the RBI is manning the check post and the RBI says, okay, give me your US dollars and I will give you INR in return. Whatever is the exchange rate on that day. So everybody will have to convert their dollars into rupees. What this does is it increases the demand for INR and reduces the demand for US dollars at that. In fact, the supply of US dollar increases and the demand for Indian rupee increases. As a result, the price of $1 in rupee terms will fall. In other words, Indian rupee will appreciate against the US dollar. Now, when the investor is taking back his investment, because the rupee has appreciated, now he'll get lesser dollars than what he has pumped in. Now, when he has pumped in, $1 was 100 rupees. Now, rupee has appreciated to 90 rupees. So, when he is taking back the money, assuming he has not earned anything, he'll get only 90 rupees for his dollar. And therefore, this discourages the US investor to invest in India. He'll say, I invest in India, I pump in the money, now the rupee has appreciated. So when I'm taking back my money, I'm getting less dollars. So in dollar terms, I'm losing money because the rupee has appreciated. Sorry, slightly mistake on my part. So when you are taking back a 90 rupee is the current exchange rate. So the US guy will actually get for his 100 rupees a little more than what he has invested. So this acts as an incentive for the US guy to push more money into India, because one, he is getting a higher return, and two, he is getting additional return by way of currency appreciation. Now, this helps a country like India to attract more money. In fact, its imports also become competitive, become cheaper, and this benefits the country. But the exports also become expensive. So if somebody outside of India is trying to buy Indian items, that person will have to pay more because the INR has appreciated. This adversely affects the production in countries like India, because you are not able to sell simply because the prices in US dollar terms have gone up. And this is precisely the reason you will see that our currency will not appreciate. In fact, it will slightly depreciate. We'll keep seeing the rupee sliding against the dollar. There is no ijjat ka sawal in not having, not going back to, say, US dollar becoming 50 rupees to 1 USD, etc. We will not see those days. In fact, 100 rupees to a US dollar is much more likely scenario. And that is because you want your exports to be competitive so that there is greater demand for Indian goods, and therefore there is greater production, which leads to higher GDP. So exchange rate is a very, very dynamic thing. It has opposing impacts on importers as well as exporters. So exporters will gain from a depreciating currency, whereas importers will lose from a depreciating currency. They will gain from an appreciating currency. Now, another related concept here is convertibility of the currency. Now, we have something called partially convertible and fully convertible currency. A fully convertible currency means you can bring in and take out capital without any restrictions. Anybody can walk in with any amount of money and you can walk out with any amount of money. There are no controls. Whereas a partially convertible currency like we have in India means the RBI will keep some checks and balances. For example, you can't sell away all your assets in India and say, from tomorrow, I will start a new life in Switzerland. That will not be allowed. That is because of our history of, vulnerability with respect to forex reserves, etc. So this is the concept with respect to exchange rates. So we understood what is interest rate. We understood what is an exchange rate. Now we'll come to the third concept called carry trade. Of late, you must be hearing this word called carry trade multiple times. It is a jargon for a simple concept of leveraging and arbitrage. What is arbitrage? Risk-free profit. What is leveraging? Borrowings. So suppose you have two friends. One guy is very rich with lot of money. If you ask him for a loan, he will charge you very low interest rate because he has a lot of money. So the real interest rate that we discussed earlier, that is very low. So he doesn't mind parting with some amount of money for a very low rate of interest because he already has money to take care of his requirements. Now you have another friend, let us say, who is in dire need of funds and is willing to pay higher interest rates. Now, if you are a pure finance guy, now what do I mean by a pure finance guy? A person who has no body part called heart. So you will not have feelings, you will not have emotions, you will simply look at this opportunity and say, I will borrow from the first friend, the rich guy, at very low rates of interest and lend to this guy who is in dire need at a much higher rate of interest. Of course, there are some risks because this guy may not repay, etc. But for the moment, we'll ignore that. And in the process, you are making a lot of money. You are, let us say, borrowing at 4%, 5%, and you are per annum, and you are lending at, let's say, 12%, 15% per annum, and you make a lot of money. And by the way, that is what banks do. Now, this is what is called as a carry trade. Now, why is it called carry trade? Probably because these trades are for a short period of time, but you keep closing and carry forward the trade. You repay the loan today and take the loan tomorrow. That means for all practical purposes, the same trade is carrying on. And that is what is a carry trade. Just very similar to auto renewal of our FDs. You've done an FD for 1 year and put it on auto renewal. What happens after 1 year? That particular FD will mature, but again it's renewed for another period of 1 year. So this is what is a carry trade. A carry trade is very simply borrowing at lower rates of interest and investing in either bonds or any other asset category which earns a much higher rate of interest. This is what is a carry trade. Now, fourth concept for today, we will understand about what is happening in Japan, the third largest economy in the world. Now, post the devastation in World War II, Japan earned its growth through exports. Just like today, we have a perception of Chinese products being of low quality, Japanese products are famous all over the world for their superior quality. So there's a lot of demand for Japanese products from all over the world. And as a result, there's a lot of money flowing into Japan. People are buying goods and they are putting money into them. And as I explained earlier with respect to exchange rates, this resulted in the yen appreciating from about 350 yen to a dollar in 1971. The yen appreciated to about 144 yen to a dollar in 1990. That's a huge appreciation. And what does it mean? This means a lot of money is coming into Japan. And where was this money going? Obviously, if you are guessing, you would have guessed it right. The money was going into stock markets and real estate. In 1990, the asset bubble in Japan burst, leading to a crash in prices, real estate as well as stock market. Since 1990, Japan has been in a period of prolonged deflation. What is deflation? Opposite of inflation, a state of falling prices as against inflation, which is a state of rising prices. Now, why did the prices fall? Now, as you would have understood, Japanese people are conservative. They lost quite a bit of their savings. And as a result, their reaction was that they cut down on consumption. Now, if a country doesn't, the people of the country do not spend, then the economy of the country will not improve. So the Japanese central bank tried to incentivize people to spend. And one of the things it did as part of its monetary policy is to lower the interest rates, bringing down interest rates to zero. That means in Japan, you could actually take a loan without having to pay any interest. And for a very long period since 1990, the exchange rate, Japanese yen to US dollar, remained near stagnant. As I told you, in 1990, it had appreciated to about 144 yen to a dollar. As we speak, the Japanese yen US dollar rate is 146 rupees 146.6 yen to a dollar. That means in the last 34 years, there has hardly been any movement in the exchange rate. This is not to say there was no volatility and there was only one rate. There were ups and downs, but in a very small band, and over 34 years, which is a very, very long period of time, we didn't see any major change. If at all, the currency has depreciated by a bit and not appreciated. And that is why this situation was very optimal for what is now called as yen carry trade. What is yen carry trade? We understood carry trade is borrowing at very low rates of interest and investing in assets that earn you higher return. Now today, or maybe for the last 30 odd years, an institution or a trader could borrow Japanese currency at 0% interest. And Japanese currency is fully convertible. So there is no restriction. There is free inflow and outflow of capital. So you can borrow Japanese currency at 0% interest, convert it into dollars or any other currency, say INR, and invest in various assets in that currency. So for example, I can convert yen into US dollar and buy shares of say Apple and Microsoft, or convert that yen into Indian rupees and invest in Reliance Industries and HDFC Bank, just as examples I'm saying. As long as I'm earning more than 0% return, I make money because I don't have the risk of Japanese yen appreciating. It is near constant. And therefore, I don't have to worry about what will happen if the yen is appreciating, etc. And anyway, I'm not paying any interest on the loan. Therefore, the yen carry trade was a significant factor in infusing liquidity in global markets and fueled the rise of various markets. Not one or two, everywhere, wherever this Japanese money could find a flow, there the assets increase because you are getting free money. And we've repeatedly said in this forum that liquidity is the biggest factor in determining market movements. Now, what happened in the last 2-3 months? Something changed. What did it change? Essentially, two things. Now, interest rates in the US, as we discussed earlier, US passed through an unprecedented period of very high rate of inflation. As a result, interest rates in the US had shot up. And as a result, there's more outflow of capital from Japan. You can borrow at 0% and invest in US at 6%, 5.5%. That is great. After a very long period of time, we are seeing an uptick in Japanese consumption. So as a result, the yen-dollar exchange rate, which was near constant for 30 plus years, suddenly resulted in a sharp depreciation of yen to 160 plus levels. From about 143, 144, it suddenly went down to 160 levels. That means you need more yen now to buy that $1. This made imports expensive. And for the first time, Japan, which was facing a deflationary environment where prices were continuously going down, now suddenly showed signs of inflation. The prices were looking up because the yen had appreciated. Now, the second thing that happened was Japan's central bank moved away from its zero interest rate policy. And for the first time, increased the interest rates in Japan. As explained earlier, if interest rates increase, it will attract foreign capital inflow. This led to Japanese yen again appreciating against the dollar. So the depreciation that the yen was facing, it fell from 144 to 160. In the last 3 months, because interest rates were increased, more capital came into Japan. As a result, the yen started appreciating. Now, what happened in this 3-month period is the volatility in US dollar, Japanese yen trade suddenly shot up. A trader could no longer assume that the yen dollar rate will be constant. Kya hota, kuch nahi hota, that feeling went away. Now there was that element of risk that the currency might either appreciate or depreciate. Now, while this was happening, the US Fed, after a prolonged period of increasing and holding on to higher interest rates, now said that it will be cutting interest rates. So what has happened? Japanese loans have become expensive because there's a tad increase in interest rates in Japan, and US decides to cut interest rates. As a result, the amount of margin that was there earlier got crunched. This made a lot of yen carry trades unattractive, resulting in a lot of trades being closed. So a lot of free money evaporated from the market, and this resulted in a plunge in global markets. So this explains to you why we had a sharp fall in the recent period and why we also saw a bounce back. So if I'm borrowing at 0% and investing at 5%, and suddenly my borrowing costs increase to say 1% and my investment returns fall to 4%, this means earlier I was making 5%, now I'm making only 3%. What does this mean? Does that mean I will make a loss? Answer is no. My profit margin has reduced from earlier 5% to now 3%. So what will happen? I will cut down on those trades where I was making very fine bets, where I was playing on very small margins. I will avoid those bets, but I'll still make money on trades where my margins are good enough. So what this means is that liquidity will be impacted, but it will not dry down completely. So there's still a lot of money, free money that is floating in the market, and that probably explains the bounce back after the sharp fall. People realize that, okay, it's not the end of the road. It's not that yen carry trades will not happen. It's just that the margin has reduced. And that is the reason why we saw a bit of a bounce back. Now, does that mean the crisis is over? And are we back to normal trajectory of increased indices? And this is our topic of discussion for this monthly con call. Are we done with the correction? Is the fall over and are we back to normal times? I'm afraid that the answer is not straightforward. unlike previous instances, such as an election result or a budget announcement, in both these cases in recent times, we saw a sharp fall in the market indices, and then within no period, there was a bounce back. People simply moved on. So, is the Japanese yen carry trade crisis also something similar, or is it a little more persistent? In our view, we are unlikely to see Japan going back to zero interest rates. We are unlikely to see USA increasing interest rates in a hurry. And therefore, whatever liquidity loss we have faced, because some amount of liquidity got eliminated or evaporated because of the change in interest rate scenario in the two countries, that liquidity loss is here to stay. We will not be able to get back that liquidity. It is quite possible that we may lose more liquidity because Japan might continue to increase rates. And here we are not talking of huge amounts of money. We are talking about 10 basis, 25 basis point cuts or increases. But this can significantly impact trade volumes. It is estimated that the yen carry trades are around $4 trillion. That is a lot of money. So if progressively we see an evaporation of this money, then markets may take a hit irrespective of other macro factors, because liquidity continues to be the biggest driver of markets. Now in India, we have the cushion of money coming in from DFIs, that is domestic financial institutions. Thanks to SEBI's mutual fund Sahi initiative, we are seeing a lot of money coming in, with more and more Indians signing up for SIPs, which is a good thing. And therefore, this money which we are pumping into mutual funds will find its way into the markets, and it will provide a cushion against the free fall. However, there could be instances of violent ups and downs. And as investors, we will have to brace for it. In other words, the ride is going to be a bit rougher, although it still makes sense for us to stay put and not lose out. Another factor that comes into play is valuation. In our opinion, Indian markets are not overvalued. Nifty at a PE of around 22.5 is fairly valued. By no means would I say that it is a overvaluation. However, we need to keep looking at corporate earnings. If there's a dip in earnings, then the PE will shoot up, and that can result in some correction. Now, every session we keep speaking about macros. This session I have not done it, simply because macros continue to be good. We keep our faith and belief in the India story. India remains the world's favorite investment destination. Staying invested in equity markets for the next few years will surely reward investors. There will be turbulence ahead. What is needed is a seat belt, a greater resolve to remain where we are, and not a knee-jerk reaction to jump out of the plane, because there is turbulence. So the ride is going to turn a little rougher. We will see a lot more volatility. We may not see the kind of increase in indices the way we have seen it over the last few years, but the direction of the markets is going to be one way, and that is up. And therefore, it makes lot of sense for us to remain invested. We need to keep looking at where our investments are. We cannot afford blindly investing in whichever idea that is coming our way. We need to stick to our philosophy of roots and wings. And we will continue to do that. We look at every investment very, very objectively. And hopefully, we will deliver the results, the returns that you are going to be happy with. So with this, I will conclude my address and then probably take up questions from whoever is interested. So any questions from anyone, we'll be happy to answer. I don't see any questions in the chat. So I see one message, no questions from my side. Thanks, Manojji. Useful session. Thank you so much, Waridaji. The Google form has been shared. So please provide your feedback using this sheet. Okay, so if there are no further questions, maybe we can end the call. Thank you, Shiraz. Okay, then. Have a great weekend. Thank you. I am closing the session.